This is Macro Horizons, episode 378. Hello, Kevin, our old friend. Presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 15th. As investors prepare for Warsh's first meeting as the chair of the FOMC, we cannot help but recall the iconic 1971 lyric from The Who. Meet the new boss. Same as the old boss. Yes, there is a band named The Who. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the data highlight was without question the CPI report. Here, we saw core CPI come in at 0.2%. On an unrounded basis, it was a solid 0.2 at 0.208. Core goods actually declined 0.1%, which marked the lowest since August 2024. The decline in core goods prices is relevant because it reinforces the notion that the tariff pass-through that was seen in 2025 was, in fact, simply a one-time price adjustment and has not led to a sustainable upward trend for underlying core inflation. That being said, all else being equal, the Fed would take a reasonable amount of solace from the recent trend in core inflation, particularly on the goods side. However, the war in the Middle East has increased headline inflation and with it renewed concerns about potential pass-through over the next 4 to 6 months. Within the CPI release, we did see gasoline up 7% month over month. That compared with a 5.4% gain in April. As a theme, we've seen several of the key core and supercore measures of realized inflation moderate somewhat in May, which again is a net positive for the Fed. The supercore measure, core CPI services excluding rent and OER, increased 0.27%, which was comfortably below the prior month's 0.45%. On the flip side, PPI came in stronger than expected for May, up 1.1% and marking the highest monthly gain since November 2022. Within the details of PPI, the components that contribute to core PCE were firmer, which reinforced forecasts for the May core PCE number to come in at a high 0.3 or potentially a low 0.4. There has been a divergence between core CPI and core PCE throughout the course of 2026, which remains topical and, if anything, simply reinforces the notion that the Fed will remain on hold for the foreseeable future. In the week just past, the Treasury market performed well, largely based on progress toward a deal between the U.S. and Iran, which weighed on energy prices and subsequently offset some of the angst associated with the outlook for forward inflation. That being said, we suspect that there will be a credibility, or at least concerns about enforceability, with any deal until there's indisputable evidence that traffic is once again flowing through the Strait of Hormuz. Now, obviously, there will be lingering questions with any agreement, specifically as it relates to Iran's nuclear programs, sanctions, and the future of traffic through the Strait of Hormuz. Nonetheless, progress has instilled optimism and pushed Treasury yields back to the lower end of the local range, which is certainly a welcome development for those of us who are bullish on the Treasury market over the medium term.
Well, we might have a deal, or at least the framework of a deal, but we also might not. At this point, we won't make any concrete conclusions about the likelihood that the Strait of Hormuz is going to be open in any durable fashion, but as the blockade in the Middle East continues to play out, there is a building sense that some progress to a more normal flow of oil out of the Persian Gulf is underway. And that sentiment was, frankly, the largest driver of the market over the past week, with all due respect to CPI that on a core basis came in at 0.2% month over month, which, while below the official 0.3% consensus, was more or less in line with what investors were looking for ahead of the number, and following the extremely strong payrolls print we saw last week. As Warsh's first meeting as Fed chair quickly approaches, he's taking the helm at a moment where there's increasing evidence that the labor market and broader economy is reaccelerating, inflation faces no shortage of upside risks, all with the backdrop of oil prices that are lower than they have been, but by no means out of the woods in terms of what it means for the broader economy. Because even once a deal is signed, it will still take some time for the energy infrastructure in the Middle East to return to a version of the pre-war normal. So, welcome to the job, Mr. Warsh.
And this does provide for an interesting backdrop for the U.S. rates market as we begin to contemplate what a post-war inflation profile will ultimately look like. Much of the last 3 months have been spent looking for any evidence of pass-through from headline inflation to core inflation, with the collective understanding that we probably won't have any tangible evidence until at least the latter part of this summer. A resolution to the conflict, or at least the reopening of the strait, does beg the question whether or not the market will be willing to look past the short-term impulse for headline inflation and consider how core inflation will be impacted on the downside if the sell-off in energy prices prove sustainable. Of course, there's also the underlying question about what is the new normal for front-month WTI. Is it 90? Is it 80? Is it 70? Is it $70 a barrel? That's a question that will be hotly debated as the process of price discovery continues over the summer months. Now, it certainly isn't wasted on us that we're in the midst of driving season in the U.S. Gasoline prices increased 7% during the month of May, and nominal wages are by no means keeping pace with inflation, which in practical terms means that the consumer is falling further behind every month in terms of real purchasing power. That being said, equity prices remain at or near record highs, which has contributed to the upside for the wealth effect, and operating under the assumption that the top 10% of households continue to drive roughly 50% of consumption, as long as the equity market continues to perform well, there should be sufficient positive momentum on the consumption side to keep growth going forward, particularly when viewing the U.S. growth profile as also a function of fixed non-residential investment, i.e. the AI build-out. So putting this all in the context of the perceived performance of the U.S. economy, while we do have some marginal concerns about the state of the consumer, particularly the bottom two quartiles, at the end of the day, aggregate growth in the U.S. remains comfortably in positive territory.
And that helps explain the shift we've seen, which is increasingly sustainable, in market pricing in favor of the Fed's next move being not a cut, but a tightening to help offset the increase in realized inflation and inflation expectations. Now, we've heard a lot from Warsh about how he expects that the productivity increase resulting from AI will ultimately be disinflationary and necessitate lower policy rates. However, even that dovish bias needs to face the reality that, in aggregate, the first half of 2026 has shown a labor market that is not only remarkably resilient, but will argue at the precipice of a more material reacceleration. So as the debate continues, if monetary policy is even restrictive at all at current levels, we expect that rather than come in and continue advocating for rate cuts, the new chair's messaging will be far more balanced and instead emphasize that the economy is in a good place, and as you highlight, Ian, the fact that growth looks good, the labor market is humming along, inflation is high, but not materially reaccelerating at this stage, all advocates for a steady state of policy rates. Now, what that won't prevent is Warsh from emphasizing, on the one hand, his preference for less forward guidance and less Fed communication, instead allowing the data itself to dictate the direction of the market, along with his desire to shrink the balance sheet. And so, given that the economy is convincingly in a strong enough place to withstand a little bit more monetary policy pressure, we're expecting that the new Fed chair's biggest takeaway from the strength of the labor market at this stage is that it gives him a green light to acknowledge that maybe a longer-term easing bias is no longer appropriate, but more consequentially sound more hawkish on the balance sheet. Now, this doesn't mean that we're anticipating that QT is going to be restarted on Wednesday, but we are anticipating to hear more from Warsh about just how aggressive and in what form the shrinking of SOMA is going to take. Will that restart over the summer, or are we going to need to wait until the fourth quarter to see the size of SOMA start decreasing once again?
And it's interesting how quickly the conversation about reintroducing QT into the Fed's arsenal has become so topical. And frankly, we agree. It's an easy olive branch to extend to the hawks on the committee. It's very consistent with Warsh's longer-term objective of shrinking the balance sheet, which will then, in theory, provide the Fed more flexibility to lower rates once we are through the near-term inflationary risk. Now, it's also worth observing that Warsh will at least be able to communicate to the White House that he didn't have to hike rates if they choose to use QT instead. So it is a relatively elegant solution overall, with a nod to the fact that the funding markets do remain a complicating factor. Further deregulation is the obvious solution to any medium-term funding concerns, or, frankly, simply allowing for more volatility in the funding market at this stage in the cycle. While we're not expecting definitive clarity on this topic on Wednesday, it will surely be part of the discussion at the press conference, and we do anticipate that the market will have a reasonable emphasis on the balance sheet, particularly given the fact that no one is expecting rates to move anytime soon.
And following what we saw in terms of the formal dissents around the language of the statement at the April FOMC, we do expect that there will be a formal reworking around the language of the policy bias, some changes around the further action language that's now been in the statement for some time, if only to add some early credibility to the Warsh Fed on operating monetary policy independently from the executive branch. Now, given how strong the economy is and the underlying inflation outlook, by formally shifting the bias around the next rate move from lower to more two-sided risks, we're not necessarily expecting a dramatic market reaction to that reality, but rather more of marking the statement to market, given the fact that the shortest dated part of the Fed funds market is now upward sloping. And candidly, while it's not our base case that we're going to see a rate move anytime soon, from a probability point of view, some chance of what would maybe be framed as a quote-unquote fine-tuning hike is probably not inappropriate at this stage. Now, ultimately, some of our longer-running concerns about the consumer might ultimately require a shift back toward an easing bias, but particularly as Warsh attempts to establish credibility and be realistic about what the data has shown, a symmetric rate outlook to start his tenure at the head of the Fed makes sense.
And it's also consistent with what we're seeing in terms of pricing in the front end of the market, both Fed funds futures as well as the two-year sector. Taking a step back, Fed credibility is longer-term net positive for the Treasury market as an asset class. Not only will it ensure that the Treasury market continues to trade off of the fundamentals of forward growth and inflation expectations with an appropriate amount of term premium added, but it also reinforces the notion that the Fed does have and is committed to keeping its credibility as an inflation fighter, which should contain the degree to which medium-term break-evens can extend even in the current environment of elevated energy prices and inflation uncertainty going forward. A fresh round of credibility-enhancing comments from Warsh on Wednesday will reinforce the curve flattening bias, and while we might not see a significant sell-off in the two-year sector or outright rally in the 10-year sector, it's difficult to envision how a symmetric approach to policy at the current moment translates into a steeper curve. If anything, we're anticipating that the curve will continue to grind a bit flatter in here as the market awaits further clarity on the policy front.
Also adding to this dynamic is not a correction or any material softness in the equity market, but the fact that we have seen some pullback in stocks from the all-time highs and a modest increase in volatility, along with the increase we've seen in real rates. Both offer a financial conditions tightening impulse that will be effective in buying the Fed more time before maybe ultimately needing to raise rates. Higher inflation-adjusted borrowing costs, especially in the 10-year sector, are ultimately what's going to drive the economy's performance to the level of interest rates. And if only through the wealth effect channel, the fact that equities at a minimum are not continuing to rally multiple percentage points a day does help take some of the edge off the overall easy level of financial conditions that might ultimately necessitate the FOMC rethink the appropriate level of policy rates. So that means if the market is doing some tightening for the Fed, then the Fed doesn't have to tighten.
Dear stocks, thank you.
Buy the dip, don't be the dip.
I don't get it. In the holiday-shortened week ahead, the economic data calendar is somewhat limited, we have May's retail sales report, which is expected to show that spending increased by 0.5%. Now, within that number, we suspect that a lot of the upside will be a function of higher gasoline prices as well as higher food prices. Keep in mind that the retail sales figures are presented in nominal terms and are not adjusted for inflation. So in a month where we had headline CPI up 0.5% and retail sales expected to be up a similar 0.5%, real growth in spending has presumably been limited. The other major event will be Wednesday's FOMC meeting. This will be Warsh's first meeting as chair of the FOMC, and while Powell is still on the board and in the room, we anticipate a unanimous vote in favor of keeping rates unchanged. We also think that there's a reasonable argument to be made that Warsh will be comfortable removing the modestly dovish bias within the statement. That will offer an olive branch to the 3 regional Fed presidents who dissented at the last meeting. And with Murin no longer on the board, it wouldn't be surprising to see a unanimous vote. We also get an update on the SEP. Here, we're anticipating a slight increase to the core PCE projections for this year. We also think that the median dot for 2026 will be increased to indicate no rate cuts for this year. No rate hikes either, but no rate cuts being the primary takeaway. We then also expect the 2027 dot will be increased 25 basis points, suggesting that the path of least resistance is no rate cut this year, 1 rate cut next year, and eventually getting policy back to the 3% long-run version of neutral. Now, as has increasingly become the case, we expect that there will be a pretty significant divergence of estimates for policy rates this year as well as next year. Nonetheless, the market tends to trade off of the median, and we'll argue that no policy change in 2026 is relatively consensus at this point, which will leave the market to trade off of the nuances of Warsh's press conference. There will undoubtedly be questions about central banking independence, the influence of the administration on Warsh's policy agenda, as well as a discussion about the Fed's balance sheet going forward. If, in the event that the dovish skew is removed from the statement, we would expect the statement to be traded more hawkishly, while Warsh attempts to outline a more balanced approach to policy going forward, which is likely to be interpreted as less hawkish. It goes without saying that it's a well-worn path for the statement to be read by the market as either hawkish or dovish, and then the Fed chair's press conference offset the extremes of that sentiment. Beyond Warsh's first meeting as Fed chair, developments in the Middle East will remain topical. Progress towards a long-term deal between the U.S. and Iran will surely continue to provide tradable headlines, as will monitoring the ship traffic in the Strait of Hormuz. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with school out for the summer, we cannot help but fondly recall the summers of our youth spent rolling hoops, playing marbles, and whittling. And of course, chasing the Iceman's buggy. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/macrohorizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.